Today, folks, I need to get a haircut here, but for some comedic relief in the back of insanity, this tariff pause is going to be very bad for the factory I started building last week. Gotta love Dr. Parik Patel here, and I'm sure Apple loading up like Pablo Escobar 600 tons of iPhones on a plane to get them across that damn border before those fines and those tariffs come into play. Maybe not as bad as Apple initially thought, but here they are sitting with a cargo load of iPhones back on the other side of the border, baby. We got tariff on, tariff off. If it doesn't get any better than that, challenges in your 2015 verse today, the Ice Bucket Challenge, keep your snap streak alive and upload a perfect 6-second Vine. But obviously in 2025, you're going to keep your job to AI so it doesn't get replaced, afford a burrito without financing it, and buy a house to live in. This is the yin and yang market of Donald Trump, baby. And we got to talk about it because Ray Dalio is putting fear in our eyes. The billionaires that are getting up from Wall Street sitting there telling you guys, you need to be afraid, very afraid, recession. What are we going to do? 1920s, 30s, Great Depression. I don't know if it's going to be that bad, but you got to let this stuff pan out. We're not in a healthy market environment here, folks. You have to recognize that when you see these wicked, massive pumps by 10%, setting NASDAQ records, trillions inflows and outflows, this is not the sign of a healthy market. It's the sign of a roller coaster for market that you need to settle down. This is one of those go on vacation, come back. That's the market we're in right now here, folks, because man, after those massive whip gains yesterday to where we sit today, my portfolio in closing yesterday, as depicted here, was up almost 7%. Actually, a little more than that. I think it was up probably closer to 8% because we were down 1%. But yeah, we're going to probably wipe out more than half of these gains, if not all of them, probably by the close of today. It is absolutely wild. But I want to break this down a little bit more in depth. I want to talk about the recent inflation data. I want to talk about some of your comments, questions on the ETFs when it comes to VDY, XEI for those Canadian dividend lovers out there. I want to talk about earnings that are coming up, guidance, what all of this means in the future outlook, or at least the macro outlook for investors that are paying attention nonetheless. Though you hope you're not acting too aggressively on it. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey. Get a haircut with me and hit that subscribe button, folks, because yeah, Apple is one of the most interesting stocks right now that I've been following because like Tim Cook's been keeping it super cool, but on the back side of everything, like, whoo, baby, could you imagine throwing over 1 million iPhones onto some airliners, cargo planes, and just shipping them from India over here? Apple is still not a cheap stock, by the way. I mean, it was starting to get cheap when it dropped into the 20s, but it still needs a ways to go. I think Apple's at the current growth rate that it offers, probably somewhere between an 18, 23 PE, I think would be a little bit more favorable. Still a bit pricey, but you got to imagine in the future with AI, the fact that I don't think Apple's done growing in totality, that you could pay a bit of a premium for that. But with the growth that we have been stunted by, I mean, you got to think Apple hasn't been growing since 2021. It really hasn't seen any revenue growth. They've been doing what every company's been doing, just trying to squeeze out margin where they can. Take a look at earnings. Like, earnings haven't even been able to get up with the margin increases. Like, Apple has been really struggling. Again, in totality, I don't think this is the end of their growth, but nonetheless, you got to recognize, man, they're just giving themselves a grace period by bringing the iPhones over that they brought over because, you know, they were expecting massive increases with Trump's insanity on that board of delusion, and now we're just looking at 10% tariffs pretty much across the board. But that is still a wicked increase for the most expensive iPhone. I mean, the 16 Pro, because they're not going to stomach that. Yeah, they got 30% margins, but they're not going to lose 10% of that margin to give you a deal. They're going to probably see the iPhone, you know, go up. I mean, if you're looking at a $1,500 iPhone, it's going to go up by 10%, right, or $150, which materially isn't that destructive, but it is an inflationary pressure, which I largely find super interesting, right? Because what is that going to mean for all these companies like Apple, especially Amazon that has 60% of its product coming from China? I mean, they really need to resolve this China thing like sooner rather than later because Amazon is going to have one of the most fascinating earnings calls out there. But with all these price increases when it comes to these products that we buy from these major companies, with the back of inflation actually coming down, I'm just curious to what the balancing act is going to look like. Right now for March, we've seen inflation actually come back down to a more nominal level we haven't seen since basically September of 2024, but that's largely caused by Trump crashing the markets here. I mean, you look at everything across the board. Oil continues to find new lows. Natural gas is coming down. Heating oils are coming down. We are getting out of winter, though. Coal, wheat, copper, soybeans, lumber. I mean, you name it. And all of these prices have come down quite materially. So that's what's kind of driving inflation down. But again, now we have the inflationary bumps of products that we're using. You know, anything that's imported is going to go up a little bit. So it's going to be neat to see what, like, I think the actual April numbers are going to look like, because it's where all these tariffs are actually coming into effect. This is all kind of looking backwards. So yeah, I'm fascinated to see if we can stay in a level that'll be worth cutting rates, because I don't think Jerome Powell is excited by what's going on in this volatility. We need nominal nominalization. We need certainty. And until we have that, I don't think we're going to get to a place of less volatility in the market, especially on the back of like margin just going bananas right now. Again, it's not healthy to see this kind of market action that we're seeing, especially in index funds that are trading like tech companies, for crying out loud, or individual stocks. And this margin, I don't know if it's going to unwind. It's likely people are constantly shorting, buying into the future. There's a lot of gambling and market manipulation going on, and it's going to be neat to see how much margin unwinds through all of this. But on the back of what I think is going to be most interesting is the fact if earnings guidance revisions come out and they're actually okay, that could stabilize the market. But a lot of people are going to want forward-looking data, and you better hold on to your horses because, again, I've been touting that I buy these dips aggressively. I'm comfortable doing so. I don't care if the market goes up 10%, down another 10%. I'm just doing what I want to do. Doesn't mean I'm right, doesn't mean I'm wrong, doesn't mean you should be copying me by any metric, but I'm telling you, we are not out of the volatility because we have so much to get through when it comes to earnings with big ones, man. I mean, next from the 14th, basically all the way through the end of April, you're going to see all the major tech companies, the shipping companies, all the international companies that have to deal with the tariffs, and we're going to hear from the CEOs and how they feel about it directly. And I mean, I think it was neat because we already saw Constellation Brands, a few other companies post, and I like using Constellation a little bit because they have to do international shipping with some of their beers, some of their stuff. I'm sure they're going to start moving some of that production to the United States, but we've already seen a pretty large guidance revision overall because, their prior medium to term outlook and their earnings weren't great by any metric. I don't know why Warren Buffett's so excited about this company or why Berkshire's been buying it. Prior term outlook was 6 to 8% for basically the enterprise, year over year sales growth. They're guiding for, moving into 2027 to 2028, only 2 to 4% net sale growth. I mean, the guidance right now, these revisions, they're not great overall, right? But this is just a beer company. It's pretty moderate. I wouldn't use this as a baseline, but I can't wait. I just can't wait to get into the earnings behind all of these companies and just listening to a few select earnings calls just to see what's going on, right? But otherwise, some of you have been commenting out of my video yesterday. I guess some of you actually appreciated it, and I'm very thankful that you guys enjoyed me breaking down some of those ETFs, the lower volatility ETFs, to remove some of the pain from this market environment if you want to collect some income, ride this out. And some of those ETFs are the ones that obviously I like. And one of you asked me directly, can you make a video comparing XEI and VDY? Because you seem more interested over the lower volatility ETFs, perhaps like Devo and the option side of it, or ZLB, the BMO low volatility ETF. And there's not much I can show you. Like I showed you guys what I look for in these ETFs. It's not rocket science by any metric. They, VDY and XEI both have a very long track record, which I like. If we look the dividend growth rate over the 5 years, VDY has been about 8.03%. When it comes to XEI, it's been about 7.18, a little bit lower. Those are kind of fugazi numbers because I only really care about the total returns. I mean, you can look at the top 10 holdings. I mean, 70% of this ETF is roughly the top 10 holdings, I think. Royal Bank, Toronto Dominion, Enbridge, Bank of Montreal, Bank of Nova Scotia. These are going to be the large factors to where this ETF moves. I'm very comfortable with that. I like that kind of concentration in the Canadian economy. If you look at something like XEI as an example here, you're getting much more diversification. Royal Bank only makes up 5%. The top 10 holdings not even making up, anywhere, not even close to 50%. So you're getting way, way more diversity. If we look at the sector allocation, 30% financials, 30% energy. BDY, you're looking at basically financials making up 58%, energy at 28%, and then utilities at 6%. So almost all your money's in financials and energy with VDY. But again, like you can compare these metrics all you want, but at the end of the day, like I said, if I'm looking at past performance and where I'm expecting to go moving forward, firstly, since inception, again, VDY has offered a 10% annualized return, which really is quite astounding. Whereas if we look at it comparable to XEI, it's only been 7.33%. So regardless of dividend increases, or regardless of, the holdings and all this stuff, just the long chart really compares that VDY is offering me roughly, a 3% almost extended return beyond what XEI is capable of over the long run. That's not guaranteed to happen in the future, but I still prefer the concentration at my younger age to try and get that excelled performance. You really got to take as much as you can into consideration when you're buying ETFs with your own personal circumstance. So I do appreciate the questions and comments. Personally, what I'm really looking to buy, it's not really these ETFs because I have a lot of concern about, commodity prices, energy collapsing. Canada has a lot of exposure to the energy sector as we've seen here. So I'm not expecting like huge excelled returns in this market environment. Hopefully financials come in strong, burden some of the below. But what I am looking at buying, to be honest, as I mentioned, I'm really keeping my eye on Meta right now. I bought in way too much Google and now I'm kind of shifting, saying, buying. You know, we could upperweight Meta here. I think it's trading at the most favorable value. I think people are still missing the tech game here. A lot of people are upset by these collapses, and I just don't think they're thinking long-term enough. Don't jump off the roller coaster midway, right? Like, we're on the big downslope where everyone's going, woo! And now we're going to come back to the upside eventually here. It's just going to take a bit of time, right? But in the meantime, look for those deals. And I still see it in big tech companies because everyone's glued to their screens right now. Everyone's watching YouTube. The engagement's probably through the friggin' roof right now. Regardless of ad spend, I still think, you know, this is still a steal of a deal for Meta. It would have been nice to catch it when it's closer to 20, but I'm going to keep my eye on this and maybe continue to cost average here. But I'll obviously let you guys know what I'm doing tomorrow. I'll provide some updates, of course, when we do a more thorough portfolio overview. But for the time being, I'd love to know what you think in that comment section below.